Imagine having 10 chickens and 18 seconds to catch every single one of them. This is what it's like for most people who are in severe debt or dealing with loans or repayments that they can't keep up with. So this happens for several reasons. Lack of financial literacy, which is what this channel is all about. It's all about teaching people who didn't know financial literacy before, how to manage it throughout the rest of their lives. No matter what situation you're in right now or where you are on your financial literacy journey, I hope that this video is helpful for you. And if it's not something that you need to hear, maybe it's something that a friend or a family member would really benefit from. So, like I mentioned, this happens for several reasons. Lack of financial literacy being one of them. Emergencies. So people don't realize that sometimes, we have medical emergencies, our cars break down, our doors break, our plumbing stops working. There's a lot of reasons why people would have to go into debt or don't expect to go into debt. Life events like college, having a baby, even getting an increase in your salary can cause you to go into debt. And there's so many reasons why that happens, but the biggest one being consumerism, and we'll get to that in a later video. But those are typically some of the reasons why people find themselves in this situation where they're chasing 10 chickens at once and they only have 18 seconds to catch every single one of them. The reason why I use this metaphor is because this is very common with people who are new to credit or new to the banking system, and they've gotten their first job or whatever the case is, good credit score, whatever it is, and you walk into a bank or you apply online for whatever reason, you get a $10,000 credit card, 18 months, 0 interest APR, and then all of a sudden the 18-month is over and you have $10,000 in credit card debt that you have no idea how you're going to pay off. So whatever the reason is, I want to break it down to you on how you can consolidate your debt, or how someone else can consolidate their debt, and what the benefits are of doing so. First and foremost, what is debt consolidation and why is it beneficial to you? So debt consolidation is pretty much taking all of your debts and rolling it into one. And the reason why this is beneficial is because you have all these credit cards or all these loans with these insane interest rates, or rates that you might have gotten when you had a crappy credit score or when you were younger, and now your situation is much better. So you're able to pretty much take advantage of a lower interest rate. So bundling all of your debt into one, this is your credit cards, your loans, anything else that you can think of. So basically you're bundling all this into one. You are trying to achieve a lower interest rate, and then you get one payment for all of this. And it's usually lower than your monthly payment would be for all of your other debts individually. So that's why debt consolidation is beneficial. If you're familiar with refinancing your home, this is a very similar process to that. So how does one go about debt consolidation? You can Google 0% balance transfer cards. This is mainly for your credit card debt. And a balance transfer simply means that you're transferring all of your balances into this new credit card. And that doesn't mean that you should go out and use this new credit card. The purpose of this new credit card is the lower interest rate, and then also the fact that you now have 0% interest for another term of however many months. It's almost like a fresh start, but again, this isn't a card that you're going to be using actively once you do make that transfer. Your bank will basically coordinate with all of your creditors and get all of those balances paid off with your other creditors and transfer it over to your new bank. That's why it's called a balance transfer. We're transferring your balances from other creditors into the new one, and the new one is supposed to, the whole reason why you're doing this is because the new bank or the new creditor is offering you a deal that you can't pass up. The second way would be loan at a fixed rate. So debt consolidation with a loan at a fixed rate, very similar to 0% balance transfers. But essentially with this one is you will take the money from this loan to pay off all your debt. So you'll take out a loan and you pay the loan over a set term, meaning that you get to again stretch out your payments and the amount of months that you have to pay, which would in turn hopefully lower your monthly payment. That's the goal here with this one. With balance transfer, the goal was pretty much to lower your interest rate and to buy you more time. With loans at a fixed rate, your goal is to lower your payments and to extend your time as well. And so hopefully while you're doing this, you're making sure that you keep in mind the interest rate as well, because loans do come with interest rates as well. And you, again, in addition to making sure your interest rate is low, you should also be looking into ways to increase your income so that you can potentially pay this loan off in full. Same with balance transfer. Increase your income to look forward to paying this off a lot sooner than whatever your new set terms are. This is just so that it can give you that feeling of a fresh start right away, because I know a lot of the times when people have a lot of debt, it can go into your mental, and that can be very debilitating. So what you can do with these methods is look forward to a fresh start. That's the goal here. This isn't trying to get rid of it. This isn't trying to make it magically disappear. This is just to give you that fresh start. If your current credit score isn't the best, then this might be the better option for you, being that it doesn't require, being that a credit card still can have a really high interest rate regardless of if you're transferring your balances or not. This is also a good idea if you currently already have insanely high interest rates, so keep that in mind as well. If you own a home, then this part is for you. A HELOC, a home equity line of credit, could be your answer to your debt problems. This will only work if you have equity in your home, meaning you've been making payments over several years towards the balance of your mortgage, meaning you own some percentage of your home's value. Then you can use this method to take out a loan, home equity line of credit, to then work on paying off some of those debts. So this is pretty much you giving the bank back your equity. So you're giving that back to them. And so, and then you get a loan with agreeable terms. Hopefully, again, the goal is to make sure it's a lower interest rate than what you're at right now, or lower payments than what you're at right now. And then you pay on that. And then again, the goal is to make sure that you have made some sort of plan to get that paid off as quickly as possible. HELOCs have a ton of other benefits as well. And being that I used to work in the credit union, I used to see people coming in all the time and pulling out a HELOC, and it was just really interesting to see the many ways that you can use a HELOC to your advantage. I really hope this video was helpful to at least one person, and if there's something new that you learned in this video, I'd love to find out in the comment section down below. If you did find this video helpful, be sure to like, share, subscribe, comment, all that good stuff, and share with someone who you think would benefit from this video as well.